Welcome to Notes Receivable, including present value concepts. If you have any questions regarding the contents of this presentation, please contact your course instructor or any of our instructors for this course with any questions you have. Please note that this cohort does not replace the unit course of study materials. Note that this notes receivable is part of the unit, including cash and accounts receivable. There are numerous on your own practice questions and examples included in this presentation. We suggest you place this PowerPoint on full screen mode and/or practice these examples yourself before bringing up the answers available throughout this presentation. Included in the presentation is a hyperlink to the Wiley time value of money tables, which are also included in your course documents. Please note, you will not be using these time value of money tables or looking up the factors in these tables when you perform the related assessments for this unit. Instead, you will be provided with the required time value of money factors within the problems themselves on the assessments. Of course, both the correct and the incorrect factors. Therefore, it's good for you to know the background of where these time value of money factors come from during this cohort. It's always important to emphasize from units 1 and 2 the matching principle and the conservatism principle, and they both apply to estimates like notes receivable and present value concepts. There's one learning objective for this unit, which is to explain accounting issues related to the recognition and the valuation of notes receivable. So first of all, what is a notes receivable? It's supported generally by a formal promissory note written and signed between two parties, and it's a written promise to pay a certain sum of money at a specific future date. It's generally in the form of a negotiable instrument, which means you can discount it at a bank. A maker signs the note in favor of a payee. Generally, these notes receivable are interest bearing, a stated rate of generally annual interest, or, and we will cover this soon, a zero interest bearing note where the interest is included in the face value of the amount, face amount of the note. Notes receivable originate for a variety of reasons in business. They're for customers who need to extend their payment period for an outstanding accounts receivable, high risk or new customers. Loans to employees and subsidiaries are documented a lot of times using notes receivable. Sales of property, plant, and equipment because they involve large amounts of money, generally speaking. And finally, banks use them in lending transactions for the majority of the notes that they do with their customers, lending them money. Slide 9 is a very important slide because it summarizes the recognition of notes receivable on the balance sheet in accordance with GAAP. A notes receivable is deemed to be a short-term notes receivable if it's collectible by the terms of the note within 12 months of the balance sheet date. If that's the case, it's very simple. You record the note at its face value, debit notes receivable, less allowance for uncollectible accounts. If it's a long-term notes receivable, which means the payments are due 1 year after the balance sheet date, you record them at the present value of the cash expected to be collected. You can see also on slide 9, there are two columns. One is the interest rates, and the other one is for the note issued at value. So if the stated rate included in the note agreement is equal to the prevailing market rate on the date a note agreement is signed, again, these notes are issued at and recorded at their face value. If the stated interest rate on the note is greater than the prevailing market rate on the date the note agreement is signed, those notes are issued at what we call a premium. Finally, if the stated interest rate in the note agreement is less than the prevailing market rate on the date the note agreement is signed, these notes are deemed to be issued at a discount, and we'll be covering examples of these coming up. So let's go through the easier one first, simple one, which is notes issued at a face value. So on slide 10, you can see Bigelow lends Scandinavian $10,000 in exchange for a $10,000 3-year note bearing interest at 10% annually. So that's the stated rate on the note. The market rate of interest for notes of similar risk on that same date is also 10%. So you should remember from slide 9, right, that this note is going to be recorded at its actual exchange amount of $10,000. So what you also see here on slide 10 is a nice chart, and what we're looking to calculate on all of these types of notes is the present value of them. In this case, an ordinary annuity, because there's an interest component. Interest will be paid each year for 3 years at 10%. The interest rate's on the top here on the chart, so that's the market rate, 10%. Number of periods, of course, or years is 3 years. You can see the $1,000 of interest being paid at the end of each year for 3 years, and the principal amount of the note is $10,000. So we need to do 2 present value calculations for this note. The first one is to calculate the present value of an ordinary annuity of $1. And again, an ordinary annuity means the interest is going to be paid at the end of each year for the next 3 years. So we're going to multiply the interest being received, right? As you recall on slide 10, that's $1,000, right, each year, times the factor in this table where the market rate is 10%, and you can see across the top here, the market rates at 10, the annual interest rates, 8, 9, 10, 11, 12, 15, etc. And then the last column has the number of periods, 1 through 10. So we're going to multiply the interest being received times the factor from this table, the present value of an ordinary annuity of $1 table, where the annual rate is 10%, and the number of periods, of course, years, is 3. And right now should pop up on your screen. That factor is 2.48685. And if we multiply that times $1,000 of interest being received each year for 3 years, the present value only of the interest on the date that the note is signed is $2,487. To that, we're going to add the present value of the principal. And we know the principal amount of the note, right, is $10,000. And we multiply that times the factor in the present value of $1 table, right, because it's a single sum, where the annual rate's 10%, number of periods is 3. So we're going to multiply $10,000, the principal amount, times the factor in the table, which should come up for you as 0.75132, and there's the present value of the principal, 7513. So if we add from slide 11 the present value of the interest, 2487, to the present value of the principal, of course we get the present value of the note, which, because the market rate of 10% is the same annual rate as the stated rate on the note, 10%, the present value of the note is $10,000. So next here on slide 13, you can see the journal entries, which the company loaning the money to the other party will make on January 1, when they actually issue the note and get the note agreement signed. They book a receivable, notes receivable, credit cash. And then at the end of the first year, of course, they're going to record the receipt of the interest, right? 10% interest on the $10,000 is $1,000. So debit cash and credit interest revenue. So now with that as a background, let's move to the more complicated situation. And that's where you have a note that has no interest rate as a stated rate in the agreement, note agreement. So on slide 14, Jeremiah receives a 3-year $10,000 zero interest bearing note. Okay, so since there's no interest included in the note agreement, what dictates the accounting here for a zero interest bearing note is what is the market rate of interest for a note between two similar parties with similar risk. And you can see on slide 14 that interest rate is 9%. So how does Jeremiah record the receipt of this note receivable? So note that zero interest bearing notes must be recorded taking into consideration present value concepts. So what we have in this case, right, is no interest payments during the 3 years. We're going to receive 3 years from now a $10,000 principal amount, and the market rate's 9%, and the period of time that's being covered by this note agreement is 3 years. So in this case, we only have to multiply the $10,000, the principal amount, times the factor where the market rate is 9%, right? And the number of periods is 3 years. And that should come up on your screen. The factor is 0.77218. And you can see on slide 15 that the present value of this note, which is just the principal, no interest, is 77.21 and 80 cents. Okay. So on slide 16, the first thing we want to do is prepare the journal entry to record the receipt of the note. And up on the screen, you'll see the debits and credits. And the first debit is to notes receivable. And note that it's for the face amount of the note. And it always is going to be like that. You'll see coming up on other demonstrations is $10,000. And the discount on the note is the difference between the present value of this note, which we just calculated on slide 16, and the face value of the note, $10,000. So there's the discount on notes receivable. That's a credit at the beginning when the note is issued. So that's a credit balance, and it's a contra account to notes receivable. And finally, the amount of cash which will be transacted in this situation is 77.21 and 80 cents. So the difference between the present value of the note and its future value, which is $10,000, is called a discount on the notes receivable. In the middle of slide 16, you will then see how we calculate under GAAP the amortization using the effective interest rate method of the discount of the note over the term of the note. So date of issue, right? The value of the note, of course, is 77.21 and 80 cents. When we multiply that times 9% in the end of the first year, or for the first year, we amortize $694.96 of the discount on the notes receivable. Okay, and we'll see the journal entry of that coming up on slide 17. We add that then to the carrying value of the note, do the same thing for year 2, do the same thing for year 3. You can see that the interest revenue is growing, right, each year. And then by the end of the 3rd year, all that's left on the books is the $10,000 notes receivable, and the discount on the notes receivable balance will be 0 because you're going to amortize to interest revenue all of that discount on the note receivable. And slide 17 does it for you solely alone on one slide. So again, you can see the basis of the calculations and the footnotes at the bottom of the slide. So the effective interest rate method for amortizing this discount is something you should become familiar with because you're going to see it later in your intermediate studies when you do accounting for bonds. So now the question becomes, what's the journal entry to record the interest revenue, right? We calculated on slides 16 and 17 for the first year. Well, that's simple. Debit the discount on notes receivable account, $694.96, right? That comes from the schedule and the calculation for the first year. And then credit interest revenue, of course, the same amount. And then this will change to, in the second year, $757 and 51 cents, and in the 3rd year, $825 and 73 cents. Next on slide 19, let's address the accounting for an interest-bearing note receivable where the market interest rate is greater than the stated interest rate on the note. So Morgan makes a loan to Marie and receives in exchange a 3-year $10,000 note, which is bearing interest at the stated rate of 10%. However, the market rate of interest for a note of similar risk is 12%. So remember slide 9, right? When we said there's a difference between the stated rate and the market rate, is this note going to be issued at a discount or a premium? Why don't you look back at this time at slide 9, okay? You can see the chart on slide 19, what's happening in this situation between Morgan and Marie. So we want to calculate the present value of the ordinary annuity, that's the interest payments, and we're going to calculate the present value of the principal amount, $10,000. But we're not going to use the stated rate of 10%. You always use the market rate when it's different than the stated rate on the note. Under GAAP, we always use the market rate as the basis for calculating the present value of the note. And again, this is a 3-year note, right, by its terms. So the first calculation has to be the present value of the interest, right, like we did before when there was an interest-bearing note. And again, right, what was the market rate? 12%. So we're looking for the factor where n equals 3, periods equals 3, and the annual interest rate column we're looking for is 12%. And up should pop the factor, which is 2.40183. We multiply that times $1,000, and we get the present value of the interest, which is 2402. To that, we're going to add the present value of the principal. And again, what interest rate should we use? And by now, you know, right? We have to use the market rate always when we do these present value calculations under GAAP. So again, 12% interest rate, 3 periods. The factor that should come up on your screen is 0.71178. Multiply that times $10,000, the principal amount, and we get the present value of the principal, 7118. So on slide 22, we add up the present value of the principal from slide 21, present value of the interest from slide 20, which is 2402, and we only get 9520, whereas we know the face amount of the note, right, its future value is $10,000. So the difference in this case, because the market rate is greater than the stated interest rate on the note, is a discount of $480. So what's the entry for the company receiving the note? We're going to be the beneficiary of the note when it's paid in the future. Again, debit notes receivable at its future value, right? The stated amount on the note, 10,000. There's the discount on notes receivable, right? Still a contra account to notes receivable. And of course, credit cash, 9520. Slide 23 does the amortization of the discount, right? Similarly to what we did on the 0 interest bearing note, but the exception is there's $1,000 of cash being received on this particular note each year. So you can see the difference between the interest revenue being earned each year, which is the carrying amount of the note times the market rate, right, is 1142, and the actual cash being received in the form of interest at the stated rate. The difference is the amortization of the discount. And you can see in that column, the amount of discount amortized each year is increasing until finally at the end, it's fully, the discount on the notes receivable is fully amortized. So the journal entry here in the first year to record the interest revenue would be, you're going to get a check, right, for $1,000. That's the 10% stated interest rate on the note times $10,000. You're going to debit discount on notes receivable. That's the amortization of the first year of the discount on the notes receivable, and credit interest revenue. Okay, so please study those particular examples very carefully. Now, with regards under GAAP to the recognition of notes receivable, where the notes are received for property, goods, or services, in a transaction entered in between two parties at what we call arm's length, the stated interest rate in the note agreement is presumed to be a fair interest rate between two parties, unless, number one, no interest rate is stated. So we went through that already, right, on the previous slides, the zero interest bearing note, or the stated interest rate is unreasonable under the circumstances. For an example of unreasonable would be a 2% stated rate when the prevailing market rate on that same date is 9%. That's clearly unreasonable. And then the third one, which we're now going to go through an illustration of in detail, where the face amount of the note is significantly different from the current sales price, cash sales price of similar property, goods, or services. All right, so for the third one, let's go through it slowly and in a detailed example. Notes receivable received for property, goods, or services. So Oasis sells a corner lot to Rusty Pelican as a restaurant site. Oasis accepts in exchange a 5-year note which has a maturity value of $35,247 and no stated interest rate, so zero interest bearing note. The land originally cost Oasis $14,000, and at the date of the sale, the land had a fair market value of $20,000. So let's go back to slide 25, right? The face amount of the note, right, is $35,247, correct? It's materially different from the current sales price of similar property. And that would be the fair market value of the land, right? Which at the date of the sale has a fair market value of $20,000. Therefore, in this scenario, Oasis uses the fair market value of the land, $20,000, as the present value of the note. Okay. The difference between the $35,247 maturity value of the note and the $20,000 fair market value of the land is what? The discount on notes receivable. So Oasis would record the sale of this land and the receipt of the note as follows. Debit notes receivable, $35,247. Credit discount on notes receivable, $15,247. Of course, take the land off the books, right, at its cost of $14,000. That's purely GAAP. And the difference between the cost of the land and its fair market value on the date of the sale, you're allowed under GAAP to record that in the income statement as a gain on the disposal of the land. Okay? So please study the illustration example on slide 26 very carefully. Now we move the next step on this scenario or transaction. At the top of slide 27, you can see the journal entry, right? Which we brought over from slide 26. The question becomes, for this particular scenario or situation, what is the interest rate, the annual interest rate, the effective interest rate that's implied in this transaction? So for those of you that are Excel smart and know how to use Excel, you would enter in Excel n equals 5 years, that's the term of the note. Of course, there's no interest payment, so you would put 0 for payment. The PV of the note, present value, is 20,000, and the future value, that's how much we're going to collect after 5 years, is 35,247. And using the formula you see here on the top of slide 27, it'll come out and tell you that the annual interest rate implied in this transaction is 12%. Now, you're not going to be using Excel in the assessments, okay? So in that case, how do we calculate that effective interest rate of 12%, which Excel just provided us? Well, go back to the time value of money unit live cohort, or the time value of money course materials, right? And we have an unknown here, of course, which is the interest rate. And you will remember from that unit that there's a formula we taught you, which was PV present value equals FV future value times the factor, right, from the present value tables, okay? And in this case, the present value factor we're looking for, of course, n equals 5. We know it's a 5-year note, but we don't know the interest rate, okay? So if we divide both sides, right, by future value, you can see the formula. It's coming out that PV is divided by future value equals the factor. So we're trying to find the factor. So inserting under present value, we know the present value of this note is 20,000, right, from the previous slide. The future value of the note is 35,247. We divide dollars by dollars and we get not dollars, but a number, which is 0.5674. That's the factor we need to look up in the present value of a dollar table, where n equals 5 years, and then we look across the interest rate columns, and you'll find out that the interest rate, again, is 12%. Okay, so please look back at the present value of a dollar table, find that factor, it'll prove to you. So make sure you remember this formula. That's what you need in this case to figure out the interest rate. So now that we have the interest rate on the note, how much is the amortization of the discount in years 1 through 5? Well, the first year, of course, is the present value times 12% is $2,400, right, of discount amortization, debit, discount, credit, interest income on Oasis's books. Year 2, now our present value has grown to 20,000 plus the amortization in the first year, right, of $2,400. We multiply that times 12%, and the second year, the amortization is $2,688. And we follow that same logic and calculations for years 3 through 5 until the $15,247, the original discount on the note, is amortized down to 0. So what's left on the Oasis's books after 5 years is only a note receivable in the amount of $35,247, right? And that'll be paid by the party they did the transaction with, and of course then debit, cash, credit, notes receivable. With regards to the valuation of notes receivable, of course, short term should be reported as net realizable value, right? Which is the same as the accounting for accounts receivable. For long-term notes receivable, the FASB requires companies not only to disclose not only their cost, but also the fair value of those notes in the financial statements. And with regards to the fair value calculation, companies have the option to use fair value as the basis of measurement for notes receivable in their financial statements under GAAP. So at the end of the presentation here, we have some practice questions and problems for you to work on your own. So here on this slide, you see the facts and the instructions. Follow the facts, follow the instructions, do your calculations, and then on the following slides, you'll see the answers come up step by step. And again, you should do these on your own, right? And then look at the answers. So if you want any more practice on this notes receivable, including present value concepts, please go to your course resource document page, practice questions by unit, look for Unit 6, Cash and Receivables Practice, and note that there are notes receivable questions within that particular unit, Unit 6. And also go to Unit 5, Time Value of Money Practice, because remember, a few minutes ago, we went through a formula that came from the Unit 5 Time Value of Money Practice to calculate the interest rate on that transaction. So from both of these, you can download 2 Word files, save them to your hard drive, One Word file includes practice questions only, and the second Word file contains the practice questions and the detailed answers to each question. Of course, we strongly recommend you try to practice questions first and then review especially the answers to the questions you do not get correct in your practice process. Okay, so study hard. It's important to study this stuff, practice it, and believe me, the hard work will be worth it once you earn your degree. Okay, intermediate accounting is not easy, but it requires a lot of hard work and practice. Okay, this stuff is complicated, as you could see from some of the concepts explained in this recording. So a reminder that this recorded cohort does not replace your unit course of study materials. Make sure you review, understand, and evaluate critically any ratios that may be included in your course document materials for this unit. And again, a reminder to contact your course instructor or any of our instructors for this course with any questions you may have related to this unit and the concepts I just went through. So again, good luck to you on this unit, and we look forward to seeing your names on the past assessments as you pass them in the future related to this unit and the related concepts. Take care, everybody.